Hello and welcome to another economics segment. This one focusing exclusively on the world of monetary policy. So we're going to start off by looking at the main tools and then we'll look at some limitations and go from there. So I'd say the most exciting part of this reading, if I can use that term, is up front here with the policy tools. We've got three to look at. Your task really is obviously to describe them, but also know the most frequently used, which is not this. But let's get into the policy rate first. That is the interest rate central banks charge banks for borrowed reserves. So we're looking at the central bank and what they're going to charge their member banks. So that is the policy rate. That's important to remember when we get towards the bottom of this slide. How does it work? Well, we've gone for, first of all, in the first bullet point, increasing the policy rate. So the central bank is going to increase the interest rate that it charges member banks for borrowing. Well, logically, rationally, that will discourage banks from borrowing reserves. As a result, those member banks reduce their lending. So if we're increasing the policy, what you would expect to see is a reduction in the money supply, and hence increasing that policy rate is contractionary monetary policy. Second bullet point, obviously the opposite. If you decrease the policy rate, that's going to encourage member banks to start lending and hence increase the money supply. That will be expansionary monetary policy. So we can use it in either direction. Final bullet point is interesting, no pun intended, because it focuses on the US Fed. Almost all of this syllabus is global, and it tries not to focus in on any local regulations, local tax rules, anything like that. But you do see in this monetary policy reading a little bit of chat about specific central banks. And you've got one fact here about the US Fed, telling us it sets a target for the Fed funds rate. Now, what is that? Specifically, it's the rate at which banks lend short-term to each other. So just make sure you've separated that Fed funds rate from the policy rate described at the top of the slide. The policy rate, central banks to its member banks, US Fed targeting the Fed funds, which is between member banks. Obviously, there is a very close relationship between the two because the Fed charges the member banks and they have to pass that on clearly. So policy rate, first of all. Second one, open market operations. And as you can see there, that is the most often used. What do we mean by open market operations? Well, the central bank buying and selling government securities. So if you think of it from the US point of view, you are looking at the Fed buying and selling government bonds which have been issued by the Treasury. Now, your task mainly is going to be to decide whether what they're doing is expansionary or contractionary. So let's look at the first bullet point. The central bank buys government securities for cash. So put yourself in the position of the Fed. They are reaching out to member banks and they are taking from member banks government securities, so pieces of paper, promises of future payments, and in return, giving them cash. So the central bank is putting cash into the market. Well, that means the member banks have more cash rather than bonds on hand. They have more cash, they have higher reserves, higher money supply. That is therefore expansionary. If, on the other hand, the Fed is selling securities, that means what the Fed is doing is selling its bonds to its member banks, so giving its member banks promises of future payments and taking cash from them. If it is taking cash from them, it's decreasing their reserves, decreasing the money supply, therefore contractionary. Now, as it says, that is the most often used. During the crisis, 2008, we saw this taken to extremes. Not really too much in the underlying readings about it, just a brief mention, but they went as far as quantitative easing, going beyond buying government securities and giving banks cash to buying absolutely nothing at all and just giving them cash. But as I say, not really a lot in this syllabus to talk about. Then the required reserve ratio, RRR if you will, seldom changed, so open market operations the most often, policy rate, required reserve ratio, less often used. What is the required reserve ratio? Well, that is the amount of reserves, the percentage of cash, rather, that the bank must keep on reserve. So if you go to one of the other segments, you'll see in there the potential deposit expansion multiplier. That is dependent on this required reserve ratio. So if that required reserve ratio is decreased, well, decreasing it means the bank suddenly has excess reserves. Therefore, more available to loan out. You increase the money supply via money creation, and hence is expansionary. Increasing that required reserve ratio, however, will actually decrease the money supply. So banks will need to keep more on reserve, hence less to be loaned out, and a contractionary policy. So you have all of the tools. That's what's used. Now we have to talk about its impact and limitations of those impacts. So first of all, how is it used? How does it work? At least theoretically. And that is the monetary policy transmission mechanism. So how does this monetary policy go through the economy and end up, hopefully at least, increasing GDP? Because that, at the end of the day, is what we're trying to do. So you could look at expansionary or you could look at contractionary. We've opted here to look at an expansionary monetary policy. Obviously, that's happened quite significantly around the globe since 2008. Around the world, I should say, in case you believe the world is flat. So huge amount of expansionary monetary policy in the last decade. This is the theory. So expansionary via any of those tools we looked at. What happens is market interest rates should fall. There's more money in the economy, therefore it is cheaper, so rates fall. Now, interest rates, this is interesting, again, no pun intended, go all the way back to quant. If you have looked through any quant yet, one of the very first LOSs you'll see in there, it's one that asks us to define interest rates. So it's a required return, so we can use that as a discount rate. It's a return on your projects, or we could say it's the opportunity cost of consumption. And that's really what we're looking at here. If market interest rates fall, there is less incentive to save because the interest rate is the opportunity cost of consumption. When rates are very, very high, we say, look, I might as well leave my cash in the bank and earn interest. If I'm not getting anything, let's just go out and spend. That's at least the theory. So rates fall, less incentive to save. That should boost consumption. And we know from our classic C plus I plus G plus X minus M that that's part of GDP. So that's number one. Number two, asset prices increase. Interest rates fall. Asset prices should be higher. Again, from your MPVs, from your quant, you should be aware of that. Now, if asset prices increase, there is a wealth effect. People now have more wealth. And if they have more wealth, they are more willing to consume. So more impact on consumption. Thirdly, people look to the future. Expectations for economic growth increase. Now, we can talk about whether that happens when we move on and look at limitations, but as long as this central bank is credible and people believe it, then they'll see expansionary policy, they'll expect growth, and hence expect further decreases in interest rates, which will help investment and again get GDP going. Finally, domestic currency should depreciate. So if we're looking at a decrease in rates here, assuming we get a decrease in real interest rates, it becomes less attractive to hold our currency. And if it's less attractive to hold our currency because you don't get as high a return, people pull out. People sell our currency, which should cause it to depreciate. Well, that means import prices up, export prices down. That should reduce imports, boost exports, and again, help GDP. Overall, we should get an increase in aggregate demand, GDP, employment, and inflation, and the economy gets going, at least in theory. Now, central banks, if we want this monetary transmission mechanism to happen, we want to make sure we have an effective central bank. Otherwise, people will start second guessing it. They'll behave in ways that don't help our policy get implemented. So we need to be as effective as we can. Three things you need to be effective. Number one, independence. And before you scream at the screen, nobody is claiming it's absolute. Clearly, there is some degree of government, I don't want to use interference, that sounds pejorative, but government involvement in policy setting. But they should be to some degree at least independent and free from political interference. So operationally and target-wise, operational independence, they are free to set their policy rates. And target independence, specifically looking at the ECB, they set the inflation rate, measure inflation, determine horizons independent from any government interference. Now that's important because if the government got involved, there are incentives from the government side to start potentially manipulating deliberately where inflation is going. The all-time classic example, what if you have a government hugely in debt, and is seeking to try and reduce the value of that debt? Well, the value of debt reduces as inflation rises. So they would have rather an incentive to let inflation climb and get out of control. So you'd like to see the central bank being independent from any of that kind of interference. Secondly, we're looking for them to be credible. So they set their targets and they follow through on those intentions and policies. And thirdly, they are transparent. So you can see the numbers they are using to come up with both the targets and the results. And if you can hit all three of those, if they are independent, credible, and transparent, they can influence expectations. And if they influence expectations to a certain extent, those targets become self-fulfilling. So the all-time classic, probably most common inflation target, 2%. So let's say we are setting a target of 2%. We are independent, credible, and transparent. The market believes that we will hit that target. So if I'm now looking at wage demands, trying to work out what wage increase I expect, I'm now going to start building in 2% because that's where I think inflation will be. And if I start to build that 2% in, it becomes self-fulfilling because wages start to go at 2%, which helps us meet the target. And if that's the case, they are anticipated, they're much easier to implement. If people don't believe us and have all sorts of different inflation expectations, it becomes harder to hit that target. So that's when things go well. The effects on the economy as a result. Well, we're looking specifically here at open market operations because it is the most common. You'll see a lot of similarities here to that monetary policy transmission mechanism because buying, selling securities is just one policy tool. So what happens? Let's say we buy securities. So make sure you're comfortable with this. Buying securities, I'm taking pieces of paper from my member banks and in return handing them cash. Well, if I'm handing them cash, more money in the economy, that is expansionary. So the result we're looking for here is an increase in aggregate demand. And that certainly could just be the exam question. But any of these bullet points are examinable. What happens when we buy securities? We've already mentioned this in the transmission mechanism. Bank reserves should increase. As a result of bank reserves increasing, lending rates decrease. More money available, lower cost of money. As a result, short-term and long-term lending rates decrease. Okay? So short-term rates decrease. That's really just a restatement of point 2. And long-term. Okay. Hopefully so. But we will revisit that when we look at limitations very shortly. Businesses increase investment, rates are coming down, more profitable opportunities with lower rates, easier credit. Consumers increase purchases, makes sense. Again, think of interest rates as the opportunity cost of consumption. And again, in the transmission mechanism, we already mentioned domestic currency depreciating, helping our trade balance. Therefore, as we said, aggregate demand will increase. So monetary policy at the moment looks completely infallible. Targets. What do central banks actually target? Well, we talked in a different segment when we set the scene that mostly it's inflation. And your classic targets are somewhere between 1% and 3%. However, that's only one type of targeting. Central banks may try and target interest rates. So increase money supply when rates are above and so on and so forth. Inflation targeting, as I say, the most common. So then we're increasing the money supply when inflation is below the target and vice versa. Always your target is above 0. Economists are scared to death of deflation. Remember, deflation is prices dropping. Disinflation, prices are still rising but slower. Deflation is prices dropping. The theory, if prices are dropping, then people hold off on consumption. Why buy it today when you know it's going to be cheaper tomorrow? That is at least the theory. Obviously, it has weaknesses. People are not going to starve to death, but that's the idea. It prevents consumption. So nobody wants deflation. We always look for a little bit of inflation in the economy. So that's interest rate, inflation. We could also have exchange rate targeting. So if you've got exchange rate targeting, your central bank is actually trying to manage where your exchange rate is. So they'll be buying and selling your domestic currency to try and appreciate or depreciate it. Well, that's fine if you're trying to control your currency, but what it means is you can't really react as well to domestic economic conditions. You're using your monetary policy tool for your forex rather than looking at what's happening to your business cycle, your GDP domestically. But if it is successful, what should happen is you'll start to import inflation. You'll end up with the same inflation rate as your targeted developed country. So if we're trying to set our exchange rate with the US, we should end up with the same inflation rate as the US. The mechanics for that, all of your parity relationships effectively, which you'll see in the global economics section. So it could be inflation, could be interest rates, could be exchange rates. Okay, finally, before we look at the limitations, the neutral rate of interest. This is a determine LOS, so it's just kind of talk about it in the exam. But I'd be quite happy as an examiner giving you a couple of numbers to look at in this. It's not too tricky. The idea is we can look at the interest rate, the policy rate that's in place, and we can decide whether it appears that the central bank is being contractionary or expansionary. So for example, let's say we see a policy rate of 5%. Nice and transparent. We can see that they're trying to target 5%. Well, all we then do is look at the neutral rate of interest. To get that, two simple things we need. The trend growth rate of real GDP. So it might be that we look at all of our economic reports and we see that GDP, real GDP, tends to be growing at 3%. Stated target inflation rate, let's say their target is also 3%. So growth rate of GDP 3, and they're targeting 3%. That would give us a neutral interest rate of 6%. Now, if we observed a policy rate of only 5 and the neutral is 6, well, their interest rate is below the interest rate that they think would just keep the economy on track. If they're bringing it down lower, they are trying to kickstart the economy. That's expansionary. If, on the other hand, we observed 7, they're keeping interest rates higher than the neutral rate, the rate that would not impact the economy. Therefore, that would be contractionary. So I certainly think you could be asked just to compare and contrast a couple of numbers in there. Okay, a couple of slides to finish off on what can go wrong. The limitations are as follows. It certainly isn't infallible, and we've seen monetary policy used to, as I say, varying degrees of success over the last decade or so. So a quick list we need. You need to be able to tell the examiner these limitations, identify them if he describes them, and also obviously describe them to him if he wants the correct definition. So number 1, long-term rates may move oppositely to short-term rates because inflation expectations change. This is why I paused when we were in the monetary transmission mechanism. Short-term lending, fair enough. You put more money into the economy, is the example we talked about in the transmission mechanism. Banks start to lend to each other, short-term rates should fall. But inflation expectations are a part of long-term rates. So if short-term rates fall and the bond market is looking at the bank and thinks, well, these rates are too low. Not only are you stimulating the economy, but you are overstimulating it. So you're going to cause a big spike in inflation. Now, if that's the case, when people are looking at long-term rates, they're going to build in higher inflation into long-term rates. Therefore, you'd see higher required returns in the long term. So that's the opposite of what the bank is looking for. If we're trying to stimulate the economy, but longer term rates are getting higher, people are not going to be incentivized to borrow those long-term loans. Therefore, you might actually calm the economy down. So point number 2 linked into that, if monetary tightening, let's say, is very extreme, and again, the bond market thinks you're going too far, very extreme expectations of recession might actually make long-term bonds more attractive. The bond market, and the term used in the underlying readings is bond vigilantes, they think, look, you're going to undershoot your target here. It's too extreme. Therefore, longer-term bonds are going to be more attractive, decreasing your long-term rates. We've got very little inflation built into those long-term rates. So it's once again very important to be credible and to have these bond vigilantes believing that you are taking the correct action as a central bank. Number 3 is the classic liquidity trap. Demand for money, very elastic. So it doesn't matter what you do with the money supply, what you do to interest rates, people are just sitting on it. That's the liquidity trap. You keep throwing money out there and it just keeps falling into this trap and nobody goes out and spends. And if that's the case, the money doesn't get into the economy and you don't get an increase in GDP. Finally, 2 more. Number 4, banks may not actually start lending cash even though you're throwing it at them. And this again is something you can go back and reference and see from the 2008 crisis. The Fed threw money, as much money as they could, at the banks, all through their QE programs and so on, and banks just sat on it. They were too scared to lend to each other because of the fear that whoever you lent to was about to collapse. So that cash just sat in banks, and they, instead of spending it, lending it, just bolstered their capital balance, bolstered their balance sheet, if you will. And finally, short-term rates cannot be below 0. Obviously, out there in the real world, you start to see negative rates over the last 5 or 6 years. But from the central bank's point of view, they can bring that policy rate down to 0. Beyond that, they don't really have any more effective monetary policy. So that limits their ability to act against deflation, dropping prices. As we said, everybody in the world hates deflation.